So in sensitivity analysis, we've been looking at how sensitive a evaluation is to changes or variations in one of the parameters that we had to input to get to that valuation, on the auspices that it might be different, that our assumption may be off by a little bit or quite a lot. And so we've been doing that. We came up with our sensitivity graphs. Well, break-even analysis is a variation on the theme. So we're going to take our sensitive analysis, and what we want to know is, what is the threshold at which point in time the project becomes viable for that particular parameter, or a variety of parameters. So in the previous example, break-even analysis might have been used to answer the question, what hurdle rate or minimum annual rate of return would result in a zero present worth. And it can be posed like that, and then you can look at your sensitivity graph to answer that question. So break-even analysis can be applied to multiple projects and can answer questions such as, over what range of a particular parameter, like interest rates, is project A the better choice? Or for what production levels are we indifferent between the two choices? So yeah, there's a lot that can be done with break-even analysis. Just a matter of kind of formulating where the questions, the real viable, honest questions are with regards to some of the uncertainties associated with some of the parameters that we're using. So the point of doing this analysis is to try to get a better understanding of how sensitive a decision is to changes or errors in the parameters of that assessment, like we got in our sensitivity graphs. So when used for a single project, break-even analysis shows us how sensitive a project's evaluation is to changes in that project parameters, but more specifically, at what threshold does it go from being viable to unviable for a given parameter, that type of thing. So we're going to continue on and demonstrate this using our example from the sensitivity graphs. And we're going to look at the St. Lawrence Power example and expand upon some of the information provided by the sensitivity graphs. So the present worth of the cogeneration plant that they're considering is quite sensitive to the savings in electricity costs and the minimum annual rate of returns and the initial cost. So some of the questions that could be posed, what range of values results in a viable project, i.e. where the net present value is greater than zero? Or what are the break-even parameter values which make the net present value of the project zero? So we're going to construct a graph to illustrate the net present value of the project as a function of each of the three parameters that we just described. So if we bring in the first one, which is the minimum annual rate of return, so it's shown along the horizontal axis, and the present worth for varying values of that parameter shown on the vertical axis. And of course, what we know is that where it crosses the horizontal axis is the break-even point. It goes from being a viable project to an unviable project. And so in this case, the break-even chart for the minimum annual rate of return is 17.7%. Likewise, we can come up with a similar chart. This is your sensitivity graph using first cost in millions of dollars here. And we see that if the first cost were to exceed $4.13 million, our project would become unviable or non-viable. One of those two. And finally, when we look at the electrical costs, we can see here that as electrical savings go up, we cross a threshold at $0.85 million. If we're not getting that in savings, then it's not worth the investment to go forward with the project. And so these are the thresholds or the single values for those specific parameters that show when it transitions from being viable to not viable. Now, when we look at multiple projects, it's a little bit different, a little bit more complicated, and perhaps even more useful. So how do changes in parameter values affect the project or projects that are chosen? So easy enough, as we just saw, for multiple independent projects. Break-even analysis, just you carry it out on each project independently. You choose the parameters which are important to you or you think have the greatest uncertainty, and you verify the sensitivity, and you can get to those thresholds. For mutually exclusive projects, where you have to choose between projects, the best choice will seldom stand out clearly superior from all points of view. Depending on values that you choose for the parameters, one project may be the preferred project in some instances and not the preferred project in other instances. And so the best choice may depend on what you choose for an interest rate, a level of output, or first cost. And of course, these parameters are usually assumptions, or they're best guesses, or they're planned opportunities, but there is an uncertainty around whether you're actually going to hit those targets or not. So the break-even comparison then can reveal the range over which one alternative is preferred compared to the next. So we'll look at an example, and in this case we have a company, Thousand Islands Finishing, and they need to build a new sawmill to support their local product line of hardwood custom detailing. So they've got two choices. They've got the local choice, Ottawa Valley Saws, and the international choice, International Tools Inc. So the proposals are shown on the table, and we see there one is a 7-year project, the other one's a 10-year project. Probably to look at the gist of it, so International Tools has lower upfront costs, but a higher annual fee or per unit production. So not as efficient, takes more to produce units as far as costs go, but it has a lower upfront cost. Ottawa Valley Saws, on the other hand, it's more expensive, it's going to last longer, and it has a fairly low, or extremely low, per unit cost of production, so highly efficient and effective from that sense. So the company, Thousand Islands Finishing, is currently selling about 5,000 units per year, but they are also expecting that the market is going to change, right? And that's perhaps one of the reasons why they're considering this investment at this point in time. And they can reasonably anticipate that production is going to go up to 15,000 units per year and has an upside as high as 50,000 units per year. So the question being posed is, which is the preferred supplier? Is it the local company, Ottawa Valley Saws, or is it the international company? If the production remains stagnant at $5,000 per year, so no growth in the market, or grows to, and it indicates $30,000 per year, and we'll look at the trend and see what's going to go on. And what is the transition point from the production perspective, if there is indeed a transition point? And finally, there is some concern. So Ottawa Valley Saws, imagine it's a new company, new local company, and they might have, some grand ambitions or a bit of an exaggeration going on as to whether their per unit cost is really truly as low as it is stated. And so there's some concern that if it isn't that low, whether we're going to make a decision right now based on a parameter which is not achieved, and whether that would change our opinion going in or our decision going in. So we want to look at the per unit cost for Ottawa Valley Saws and see how that might change our decision if it goes from 1 cent per unit up to as much as $1 per unit. So here we have a production table. So basically what it's showing us is for different quantities of annual production, what the annual worth would be. Now we've gone with annual worth in this case because the duration of the projects are different. And of course, for us to compare them, we need to actually have the same period of study. So annual worth is one way that we can achieve that. And so rather than looking at net present value, we're looking at annual worth. It will produce the same outcome. but just a little bit easier to do in this case. So what we see is, as we expected, the lower the production, the more favorable the low upfront cost is going to be, whereas the higher the production, the per unit cost is going to start to dominate the valuation and the selection. And so we've graphed it out between 5,000 and 50,000 units and what the annual worth is. And, we basically see that in the early stages, from current production levels at 5,000 through to some value, International Tools, their offer is benefit or preferable to the Ottawa Valley Saws. However, at some point in time, they transition. Ottawa Valley Saws becomes the preferred option and has a much better upside to it. The opportunities as we extend production, we're going to see a lot of profits, if you will, later on, if we do indeed realize that production growth. And when we look at it, we can do a little bit of calculation, a little bit of interpolation. The break-even point, so our break-even analysis, is just under 11,000 units. So basically what that says is, with the parameters as identified, if we get growth that will see production go beyond 11,000 units per year, the Ottawa Valley Saws is going to be preferred. However, if we stay below 11,000 units per year, it's actually preferred that we go with the International Tools offer. So the other thing that we wanted to do is we wanted to look at how things would change if that estimate of the per unit cost for Ottawa Valley Saws was perhaps optimistic. And so what we've done here is, for 3 different production scales, and we've chosen 5,000 units per year as our current production rate, 15,000 units per year, which they say that's reasonable to achieve. We're really expecting to achieve 15,000 units per year, or 25,000 units per year, which of course would start to trend into the upside and show us what the opportunities are. How sensitive is our decision to changes in that assumption about per unit cost for the Ottawa Valley Saws? So we've done it up for International Tools and Ottawa Valley Saws at each production level. Of course, the International Tools is constant because we're only changing the per unit cost for Ottawa Valley Saws, so that's going to be constant. And then we recalculate for different values varying from 1 cent to $1.50 per unit what the annual worth is going to be for the Ottawa Valley Saws proposal. And then we redo that for 15,000 units, and then again for 25,000 units. And so in the graph, what we're showing, so this is a graph of one of those scenarios. So I've chosen the 15,000 units per year because that's our really expected production level. And we've graphed it out. So we have International Tools, of course, is a horizontal line because it's constant. And we see that the annual worth for the Ottawa Valley Saws, as you would expect, will go down as the per unit cost goes up. And so it's heading off there, and we have a break-even point of 95 cents per unit. So it's actually not as sensitive at that production level. It's not as sensitive as you might have thought it would have been. We're actually fairly high, pretty close to the dollar. So you'd have to be off by quite a lot for it to change our decision at the production level expected of 15,000 units. So to summarize then, what did we learn through doing our break-even analysis on this scenario is that at the current production, 5,000 units per year, International Tools is the preferred option. And actually, in the Ottawa Valley Saws option is not even viable. We would lose money on that investment. However, higher production favors the Ottawa Valley Saws. We kind of anticipated that just by looking at the parameters going in. with a break-even point of around 11,000 units. Upside greatly favors the Ottawa Valley saws. If we really do realize some of that high-end production growth, we're going to want to be on the lower per unit cost option. And at 30,000 units, Ottawa Valley Saws has a very strong advantage with annual worth comparisons of 164,000 for ITI versus 230,000 for Ottawa Valley Saws. So the Ottawa Valley Saws, as we saw, is sensitive to changes in its per unit price, which is its strength, but remains favorable at expected production levels. The break-even point at 15,000 units is 95 cents, and this is at the very high range of possible. And I would posit, how likely is it that we're going to get there? And that will come back up when we talk about the strengths and weaknesses of the break-even analysis. So to summarize, break-even analysis is a simple tool that can be used to extract insights from a modest amount of data, and a spreadsheet, and copy things down from a series of rows, and you can get the information you need to do a break-even analysis fairly quickly. It communicates threshold or break-even parameter values where preferences change from one alternative to another, which is probably one of its strengths, as well as from viable to not viable for a single project. The main disadvantage, if you will, of break-even analysis is that it can't easily capture interdependencies among the variables themselves. And I would say not only that, it doesn't really calculate the probability of the scenario or what parameter being high or low. That's not incorporated into this. It can be, as we will discuss later on, but it's not built into the break-even analysis at the outset. So that's it for break-even analysis. Quick introduction to the concept, a growth of the sensitivity graphs, using the sensitivity graphs and key intersection points to describe a threshold change in our valuation from one choice to another. And we're going to come back. We're going to talk a little bit about scenario analysis and then try to wrap up this whole numerical business case analysis. So we'll see you on the next one.